my Lord. Yes, get your pens and papers ready. I'm going to share the screen with you and let me know where you're from. Put it into the chat box. Sunny Auckland in the case of Peter. We've got sunny Chesterfield in the case. I like that. Cornwall. Now, we're going to share the screen straight away. I've got a whole load of new stuff for you. Let's start off with the S&P 500 over the past year. This is what it looks like. And I could not have forecast that a year ago, which is why I have more than one stock, obviously. I could not have forecast. I mean, the highlights for the year for me were Alphabet being up 60%, a surprising highlight because I would not have thought 12 months ago Alphabet's going to go up 60%. The other surprising good highlight was JP Morgan up 33% for me, and whereas Goldman Sachs up 52%, half century there for Goldman Sachs. The disappointments, but I don't get disappointed by these things. Amazon, Apple only up 2% and 5%, and Microsoft only up 11%. I think they're saving themselves for 2026 because that's a load of profits they're going to move from the P&L to the balance sheet, which is going to make them look even cheaper. Meta, bit of a disappointment, only up 10%, but Eli Lilly up 35%. Yay. So that's what the S&P looks like. We're going to break this down, and more importantly, rather than just look backwards, what can we look at going forward? By the way, Palantir and CrowdStrike still very popular with the news channels, the CNBCs and the Bloombergs, and quite frankly, I'm sure if you held them long enough, they'd continue to do well for you. If I was going to put one that got away, I guess Lam Research and Intel are both ones I've mentioned very often, but not ones which we've had for the whole year. Intel not had at all. Lam Research I've had in the past, but because they got crowded out, we've got a good squad. It's like our squad is Real Madrid or the Brazil football team. Can't put everything in. AMD's been great for us. As part of the Quality 5 Plus, that's up 72%, bit of a smaller player. But then a disappointment, Qualcomm only up 9%, but don't mind holding that going forward. Anyway, Micron was a sort of knockout winner. These squares are based on the market capitalization of the companies. Bigger the company, bigger the square, and therefore bigger the impact on the S&P 500. So what you see there is, Richard's from the Gold Coast in Australia. This is amazing. We've got Joseph from New York, so we've got quite a lot of the world covered. So what you can see, that hi Paresh is green as well. What you can see over there, Micron 225% up, but it'll have a smaller impact on the S&P 500 because it's the smaller company. I guess we could stare at this all day long, but we want to look forward to what's happening in the market going onwards and which of these might be good for the next 12 months. Now, the one thing I'll say to you over the next 12 months is I'd far rather stay to you portfolio level than individual stock level. Because if I go individual stock level, then I've got to try and work out next year whether it's going to be Microsoft or Alphabet or Walmart or Costco or Philip Morris or whatever. If I go portfolio level, it's a heck of a lot easier to say if the S&P goes up 16%, as Morgan Stanley thinks so, I should get a 30% return at least on the portfolio. The problem with retail clients is they want to know stock level. Well, let's make the stock level, let's take that to an absurd level. Oh, okay, we'll go down to the stock level. Well, why don't you go down to which month the stock's going to go up and which stock? And then you're getting into trading. And why don't you just work out how many minutes it's going to go up each day? Because if you can get that right, you could make $1 trillion in a year because you just get each minute in, out, which is what a lot of the bigger hedge funds do. We're not in that category. So for us, it's a question if you go higher up the pyramid and you say, well, we're not going to try and predict microcosm, what's going to happen on which day for which stock and how much it's going to move. What we're going to do is not even look at the stock, but look at the portfolio as a whole and say, as a whole, it should do this. But which one of those is going to do well, worse? We don't know. They're all good companies, just as these are all good companies. But as I said, JP Morgan did just as well as NVIDIA. Couldn't have forecast that in the overall portfolio. So we're not looking at the trading side of things. This is the S&P 500 over 1 year based on sectors. So different sectors, different colors. And what you see is obviously Micron, Lam, Palantir, a lot of the sort of technology companies, the IT companies over there, and there's the ticker symbol. And then you've got some of the financials over here. Healthcare is more over here. This is just the S&P 500, okay? Just the S&P 500. And I guess the runaway, again, has been a few of these over here, which have stolen the show. But the other reason I want to show you this bubble graph is to say, can you imagine at the start of the year asking someone which of these bubbles is going to be higher and lower? In fact, next to impossible. It's ridiculous. That's why it's a lot easier to say, well, I think overall will be higher or lower. And as I've said, if the S&P 500 delivers a 16% return, then we should do, I'd expect, double that, because historically that's what is a fairly good estimate of what would happen. If it has a 2022 type of year, we'll get 0% returns because we'll end up holding cash for a lot of the year. Okay? So that's what I'm saying. When newsletters sort of try and say to you, oh, Palantir is going to go up this much in this time frame, that's great. And let's say they get it right, because if you point enough at these bubbles, some of them you'll just get right by chance. They'll try and sell you the newsletter off the back of the one or two that they got right and try and ignore the ones they got wrong, which is why, as I said, it's a lot easier to think like Warren Buffett and think at the portfolio level, not the individual stock level. This is the Russell 2000. These are 2,000 smaller American companies. And we'll look at UK in a second. And what's interesting about this is that the healthcare companies have been doing rather well. Now, you can see the vast majority of those companies are obviously 0% or slightly up, slightly down. But healthcare has actually been fizzling along. Now, I don't gamble on companies by their size. Russell tends to be smaller, and there is some talk that smaller companies should catch up at long last. There's been some talk, and also people like to gamble on sectors. So they go, oh, healthcare will have another good year. I don't know. It might do. There is certainly a hypothesis worth testing, which is if the Russell 2000 in 1 year had very good returns in a particular sector, does that sector follow through in the bigger caps the next year, or does it follow through the next year at all? That's how you should be thinking. Is that a hypothesis that was tested? No, it isn't. Therefore, I must be speculating, i.e. guessing, gambling, if I do it on that basis. So all I can say to you is, here's some data, don't read anything into it, because there isn't a conclusion, there isn't a hypothesis we've tested on this data. There's a lot we could test, but we just don't have the time, resources, energy to do it. So why am I showing you this? I'm just saying it's interesting that on the Russell 2000, some of the energy companies, some of the healthcare companies have been doing incredibly well. And it might be something we look into, but quite frankly, we're not in need of more ideas. We've got the right idea. We've got the right strategy. Undervalued companies, high growth, dividend yielding, high average returns with low downside volatility, i.e. high Sortino. So we've got an idea. We're not looking to create new ideas all the time and think of new strategies and just sit there. Because quite frankly, like Warren Buffett, we don't like to work hard for a living. We've got a strategy. We've got an approach. It's fine. It's working great. Okay. And has been for 25 years. So we're not looking for new ways of skinning that cat. This is the Dow over the last year. Now, the Dow only has 30 stocks in it. Okay. And that's how the Dow Jones Industrial Average has performed. Now, the Dow as an index is slightly unusual in that it's not the 30 largest companies in the United States. It's decided by a committee of companies which are representative of America. So it's quite unusual in that for many years, NVIDIA wasn't in the Dow 30 because they're a bit sort of traditional with the Dow and sort of, we'll put the old-fashioned companies in like Coca-Cola. And NVIDIA only got in, I think it was 2 years ago, if that, or 18 months ago, it entered the Dow. Somebody can, I'm sure, Google that. So that again, just out of interest, I'm just saying. Now, let's say you've got 30 companies in your portfolio, and that's what it looks like. That's roughly on average about a 20% return. You'd be happy if your pension went up 20%. The thing is, if you'd look at that, there are certain companies I wouldn't want, well, which I would want, because year after year they've had great performances, and I got surprised to the downside, like United Healthcare, UNH there. But there are others where I just don't want them in there. Nike tends to be fairly mediocre. Coca-Cola, it's all right, but it's more a utility company nowadays because it's such an essential thing. PG, household, what's it called? Massive company, God. Paresh, what's PG?
Procter & Gamble.
Procter & Gamble, that's it. Procter & Gamble, probably not one which is going to sort of blow my socks off. But you can see there's some great numbers there. Now, surprise to the downside, United Healthcare and Salesforce. Salesforce is CRM, down 22%. Bit weird. Good company. Probably have a good year the year after. That's not to say I'm going to pick from these. I'm just saying that even with the Dow, there's some great numbers in there. To give you overall, I think the Dow's up about 20% so far. We'll see in a second this year. This is crypto, by the way, over the past year. So gold has been the safe haven bet. It hasn't been crypto. And you might think, well, obviously it's not crypto. Why would anybody put anything into crypto? Sorry, that Ethereum, Bitcoin, BNB, I think is Binance, something like that. Ripple, XRP, which I've got and I've had for, well, I've got Bitcoin, Ethereum, and Ripple. I've got Sol as well. Is that still there? Anyway, whichever one that one is, I've got a bit of. So as you can see, don't come to me for crypto, because that's what you'd be looking at. What a mess. I've only got crypto for fun. In the same way, my son has got Lego for fun. And I've had XRP for about, I don't know, 6-7 years. And I think earlier last year I broke even, but I think we're now back up to break even again. Great, thanks, 8 years. I suspect these will one day do what gold's done this year and just take off, and I'll think, oh my God, why didn't I have more of them? So I keep an eye on them, just a bit of fun. Like I said, it's almost like a collector who's collecting stamps. It's like, I'll keep an eye on the price. If ever it starts going a little bit vertical, I might buy more into them. But anyway, don't want to talk a lot about crypto. It's purely done for fun. It's not really part of a pension or anything else. This is the world. Now, people often say to me, oh, you're all invested in the US. You're so biased. What about diversifying around the world? They don't actually speak with that accent or that tone of voice. Every single one of the companies you see there is listed in America. You might think, hang on, no, it's not. HSBC is listed on London Stock Exchange. They've got American depository receipts, which is essentially, think of it like a dual listing on the New York Stock Exchange. So you could access Chinese companies like Alibaba or PDD, Pinduoduo, I can't pronounce it, or Baidu, or all the others over here, China, Japanese companies like Sony. You can access them through the New York Stock Exchange anyway. ASML, which most people don't realize, whilst it's a tech silicon chip company, it is a Dutch company. So I can get my diversification anyway. And all of these get filtered into my spreadsheet of value, growth, income, cash flow, Sortino. And one of the reasons, when we first in 2004 set up the hedge fund, it was set up in the Cayman Islands. Look at that. And the reason we were investing in US equities is because of liquidity. We could get the most liquid companies, i.e., if you need to get out of a company, you could press exit and you could sell without causing disruption to the market. You can't do that if you go directly to smaller companies in countries like India, for instance. So again, America made sense because the most liquid, biggest companies are there. And we've got if any of these companies in a battle bubble up to the front like ASML, well, so be it. It'll be in our portfolio. Novo Nordisk, which has had an absolute collapse, but if it starts bottoming out and going up, we might have that. Well, that gives me exposure to what? America or Denmark or the world? Don't really care because it's about the company. I don't care what they make, because companies are factories for making money, and I don't care where they're registered, their headquarters or their stock exchange listing. What I care about is, can they make profits? Can they generate cash flow? And have they got a bucket load of assets on their balance sheet? And the assets are slightly less important, but have they consistently shown that they can generate a return for me? And when they fall, do they fall by a small amount and snap back as quickly as possible? I sort of, Scott, are you in Costa Rica? I am jealous. Hello to you, Solana. That's it. Did I say Solarium? I'm obviously thinking I need to top up my tan. Solana, you're right. So Solana I only got because my sister said to me, buy some Solana. And boy, was she wrong, because I think ever since I got it, basically, I am an inverse indicator for crypto. Okay? Do the opposite of whatever I say with crypto. Not my thing. Modern art. My wife bought some art recently. I have no doubt it'll be worthless in a few years. Don't tell her I said that. So this is the world over 1 year, and we're going to go through some stocks in a moment. But what I'm saying is, just because I can put it in a SIP or ISA and it's listed on an American exchange doesn't mean it's necessarily an American company. Look at that. There's a little South African beauty down there. Petrobras, the Brazilian petroleum company over there, and so on. Now, what I don't do is top down and say, well, I think India's doing well, let's buy some of their companies. I know people have this theory that, if an economy is doing well, you should buy into the stocks of that economy. Well, actually, no. If a company's generating profits, I don't care where it is. Of course, there's going to be a correlation to the country it's in. Of course there is. But I just want to see how well the company translates it, because very often a company has a notional headquarters in the UK, like HSBC, but is making most of its money out of China. So anyway, it's the company that's more important to me, and the balance sheet. This is the last time I'm going to get a chance to say it. Well, I guess the 12 days of Christmas, 6th of January, I can say it. But anyway, Merry Christmas belatedly to everybody. I note we're well past Christmas now, but there we go. So we're going to go into more of this detail. Before we do, same thing as before, not individual financial advice, not a solicitation to buy or sell anything. And I'm well aware that the audience is mainly falling into these categories: time poor, cash rich professionals, all the way to retirees and DIY investors who want to get it right. Let's talk politics and what's going on in the markets first, and then we'll go into more stocks. And I also want to show you some momentum-based stocks. And I want to show you the top 50 stocks to watch for the year, which Bloomberg have listed. And I'm going to give you, I created a little spreadsheet for you of those. But first, I'm going to start off with the politics. Here we go. Here's the politics. Okay. What caught my eye on this is this. So the minutes came out today from the Federal Reserve of the meeting. I don't know why it takes them so long to produce meeting minutes. But anyway, the meeting minutes were that the Federal Reserve, and this is interest rates are the key thing which are going to determine whether the markets rise or fall in 2026. And people think, what? That doesn't make sense. Surely, Alpesh, it's profits, it's bubbles and blah-de-blah-de-blah. Well, 2018, the last few months destroyed the market because of interest rates tightening. 2022, interest rates tightening. It's going to be interest rates. Okay, it's not talk and narratives and stories and war and oil, because if it was going to be those things, it would have happened already. It's interest rates. And we also know from the hedge funds we speak to, from the big private banks we speak to, that's the key story. Now, interest rates, when you're sitting on a panel, is a bloody boring thing to talk about, unless you're the governor of the bank. Well, it's still a boring thing. I mean, you've heard the governors. So everybody loves talking more about AI and blah-de-blah-de-blah. Interest rates are what determines whether the market's going to rise or fall in 2026. And specifically, whether the Fed is it's finished cutting interest rates. And it hasn't. All it said is we weren't sure whether to do it in December or not. Okay? That's not the same as we're never going to do it again. So we're okay for now. We should be okay into January and February. Okay? We'll wait for the next meeting. Now, I suspect they're not going to cut it in January or February because if they were this close in December, why should they do? Which keeps our hopes up they'll cut it later, which keeps the stock market buoyant. So I suspect the first 3 months will be quite buoyant, i.e. upward. But I reserve the right to do an update and say, oh, no, things have changed slightly, and etc. Okay, so we're going to go into that. That's the key thing. That is the one most important thing. Everything else is clickbait. Okay, everything else doesn't make a difference. Couldn't care less. Yes, it's amazing that a British company has got a $8 billion software company. It's not the kind of thing we tend to do. I met the founder of Octopus, who was on the radio just today, a couple of weeks ago, where I was on a panel. The guy's fantastic, really lovely guy. Always turns up, scruffy as hell, because I guess when you're a billionaire, you can afford to turn up whichever way you want. Copper record prices could impact macroeconomy. Not really. Okay, let's just turn this into something binary and simple. Bombing the hell out of Iran or Venezuela or Ukraine or Russia makes no difference at all. But surely defense stocks will do well. Listen, you're going to have 20 to 40 stocks in your portfolio, and they're going to be fighting to get in there out of a group of 10,000. So gambling on a narrative or a story is not the way to go, as I've said time and time again. So I'm going to go into some of the bigger stocks, but that's your big headline. That is it. That is the biggest possible headline. So what else is there? Well, these are the S&P 500 forecasts by the major banks. Deutsche Bank think you're going to go up that much. Morgan Stanley about 16% up, and so on. Who's going to be right? We don't know. We don't know who's going to be right. You follow me, so you all know that the one and most important thing I always look at is, let's do it. Here we go. Should be able to see. God, I hope I've shared my screen. Yeah, thank God I have. I've sometimes done these. I've sometimes done these, and then halfway through I've realized I hadn't shared my screen. So this is still rising, and it might continue rising. It's going to do one of three things. I've said it before. Either this is going to continue rising, and the momentum, this is the average prices, is going to continue going up, or it's going to have a short, sharp pullback and then return, or it's going to have a prolonged pullback. I don't know which one of those three is going to come, but the easiest one for me is if it just keeps going up. Thank you very much. Stock market, as it pretty much did in 2024. Boy, was that an easy year. Okay, because you only had a couple of wobbles, right? That was it. 2025 was bloody difficult during February to April, where we really thought Donald Trump was going to nuke America. I think he half wants to. 2022, in a way, is quite simple because you get a lot of stocks just dropping like this. And we're not seeing that at the moment, but it might. So at the moment, the only decision I have to make is, do I keep holding what I've got? Yes. Okay, and we'll come back to some of that in a second. Actually, whilst I'm here, let me take you through. I'm going to share this. Actually, no, I'm going to share it with you in a second. So let me share it with you in a second. 20-odd momentum-based stocks. I'm doing that almost for fun to say, okay, well, I'll explain it in a second. Top lessons in 2025 to take into 2026. Okay, this. Professional's edge, the Babe Ruth effect. How often you're right doesn't matter. It's the magnitude of your correctness. I want to put it right down here, what Warren Buffett said. Take the probability of loss times the amount of possible loss from the probability of gain times the amount of possible gain. That is what we're trying to do. That's what it's all about. Now, economists are used to this, and they tend to make better investors than non-economists. But there it is. It's on the screen. Take a shot of it. Let me explain what I mean by that. These companies presently have momentum. Now, I don't normally give you names just based on momentum. I normally, as you know, give you names based on value, growth, income, cash flow, Sortino. So this is outside of my normal pension program. But the reason I'm giving you this is because people love momentum, especially at the start of the year and talking about momentum and so on. So what does momentum on these companies look like? And what am I talking about? And this is high risk because we're talking momentum. I'm not sure whether I'd call it investing or trading. But what I'm going to say to you is these companies, ignore the two which are crossed out. These companies as a collective, this is what I'm going to tell you, in 2026, half of them, and I don't know which half of them will go up roughly 40%, and the other half are going to drop 20%. Well, you're going to have a 20% stop loss with how you do it. So you can do the math and you can work out, well, wait a minute. Let's say there's 20 companies. 10 are going to make me 40%, 400%, okay? And 10 are going to lose me 200%. 20%, which is 200%. So I'm going to have across the board the difference between the two divided by them, and that's my return. So let's have a look at this. And this is not the normal program that I teach. I'm just showing you this because I know some people love coming here for a bit of the fun. Okay, so there's 3 crossed out ones, so ignore Airbnb. So if we start off with, let me start off with Accenture, okay? What we were looking for when I said momentum for 2026, I'm doing this for almost for fun for everyone, and we can look at these and then we'll come back in 12 months. And we're not looking at our normal value growth income. I'm just repeating that. I know I'm repeating myself, but just thought I'd better repeat that again. What we're looking for is it reasonable to project forward that they can deliver at least a 40% return? Have they done it in the past? So this is not the normal great investments program, just so you all know, okay? Because I don't want any of my clients thinking, oh my God, you're teaching them something you shouldn't. And we know it's done it before, okay? The momentum we were looking for is on the weekly rising MACD and on the monthly flat and about to start rising, flat, about to start rising. Because what we're looking for is a period like this, where in the past, when that momentum started rising with both rising momentums on the MACD monthly and weekly, you've managed to get yourself a nice little 42% return over 12 months. But there's risk and money management rules that have to go in. So rule number 1, both are oversold, i.e. bottom of the graph, and starting to rise weekly and monthly. Rule number 2, a reasonable projection of 40% in 12 months, minimum, because it's done it before. Rule number 3, which is no guarantee it'll do it again. Rule number 3, a 2-to-1 reward to risk ratio. So the stop loss, because it's more like a trade than an investment, the stop loss has to be below recent support because the price shouldn't go there. If it's going to go up, it shouldn't go all the way down there. So the nearest point where you know on balance of probabilities, you should have a stop loss because the price shouldn't go there if it's going to rise. Obviously, it's not a stop loss 1% below or 2. It turns out to be here below support. And therefore, there's more than a 2-to-1 reward to risk ratio. So that's your risk management taken care of. Okay. Your money management is, should that stop loss be hit, i.e. you lose 17.5%, you shouldn't lose more than 1% of your total capital. If you've got 100 grand, you shouldn't lose more than $1,000 if 17.5% drop happens. So you can work out how much you should own of a portfolio. How much you should put into a stock based upon that simple arithmetic. Okay. So that's Accenture. Let's have a look at a few others. Adobe on the momentum front. Now, if you do only one of these, the chance is you're going to be picking the wrong one. Just sod's law. What I'm saying is, if you did all of these, half will go up 40%, half will hit their stop loss, and that's your portfolio and that's your average return. But it's going to be higher risk than I'd want to take for a simple reason. We've selected these purely on momentum alone. We've not selected these on value, growth, income, cash flow, our normal filters, okay, because we've done it almost for end of year bit of fun, okay? And there you can see it again. We've marked it. Is 40% possible? Yeah. Is it reasonable? Has it done it before? Yeah. Oversold? Yeah. Now, the mistake people make is they then try and cherry pick and say, oh, I'm just going to do it on Adobe. And Adobe, let's say, hits the stop loss, goes down 13%, and they have to exit because it's more like a trade than an investment. And they turn around, they say, didn't work, bloody rubbish. Yeah, because you can't do it with just one. I'm afraid you've got to do it with the whole shebang. So let me show you. Let's see if we can get you another one. PPG. Which one's PPG? PPG Industries. Okay. Nicely just moving across. So my team put this together for me to show you. Now, 22. Let's have a look at this and say, well, we need it to be at least 40. Is that reasonable? Well, it's done it before, but you can see it's a tough call. You're asking for a lot from the company. It's done it a few times before, so we're going to say, okay, but where's the stop loss? The stop loss is just below support, down there. Yep, more than 2-to-1 reward to risk ratio. Bang. And why am I showing you this? I'm showing you this because, like I said, for a bit of fun, there you go. Would I tell my clients on the Great Investments Program, create a portfolio of these alone? No. I'd say, no, wait a minute, guys. Why are we not looking at value, growth, income, cash flow, Sortino to get our returns that we want and our low drawdowns, and then create a model portfolio, look at the statistics, how they perform historically as well as just how they're doing now. We do a lot more filtering to clean things up. But this is, I know people love this kind of stuff, so I wanted to show you that. Those are the tickers. They're there. You can take a picture of it if you wish. It's not what I, as I said, recommend doing on the program. So I'm just saying time and time again, just so nobody's confused who might be on there. Can you point on the graph where it's oversold? It's the bottom third of the graph, but all of these were oversold. Okay, so if you were to open these up on Yahoo Finance, the MACD is the same on Yahoo Finance. We just use the default numbers because they're as good as anything else. Okay, so that's what oversold is. But if you want to learn more about that, I've got it on my free investing education at investing-champions.com. Investing-champions.com. There's a whole section on MACD. So I wanted to show you that. I want to show you something else, though. Not that one. I want to show you this. This is Bloomberg's Business Week 50 companies to watch for the year ahead. Now, I created this, or rather my team put this onto a little Excel for you, a little online table. I'll give you the link in just 1 second. Okay, with what the key catalysts for growth. So you might as well, what are you saying, Alpesh? Are these your stock buys? Are these recommendations? No, they're none of that. What it is if you wanted to know what the sort of the brains of the financial industry you think is what's going to be driving next year, and what are the key growth catalysts, okay, then the companies are one thing. Doesn't mean they're going to go up. I mean, we've not analyzed these to say they're going to go up or anything. What I'm saying is, and I like Lamb research a lot, but the point is it's giving you the growth catalyst reason for each one, which when you read it, you get a pretty quick idea of all you need to know for what is going to be key in 2026. This is not me saying you should buy Telecom Indonesia. All right. What it's me saying is you just wanted a quick update of, what's happening around the world from a stock market perspective, longer term over the next 12 months, that you didn't want to read tons and tons of it, and you wanted it in one sentence. Then it's this. Hoka and UGG. My father-in-law goes mental over Hoka and the UGG brand. It's come off a bit, but there you go. That's owned by Deckers, which actually is an American company. And you've seen they've put the estimated revenue and estimated sales in there. So if you would like that table, it's more instructional news-wise. The link is on my LinkedIn. Okay, my LinkedIn, you can find, there it is. There's my LinkedIn address. But I will also just put it on, I'll put it on the chat as well, because if I'm not mistaken, I'll put it on the chat as well, because I created a tiny URL for everyone. Okay, so I did that. tinyurl.com, Bloomberg 50, I think should hopefully work. If this doesn't work, it means I'm a fool. No, there you go. So I've put it in the chat as well. Okay, the link to that. It's also on my LinkedIn. It's right here. I just got it. I got the table from the team just before we went on air. So I created a tiny URL very quickly, which is there. So you've got it on there. I've also put it in the chat. Okay. And it's for anybody listening, tinyurl.com/Bloomberg 50. But I think that's useful for people just to know in broad terms. Now, I've said this in my previous broadcast, so I'm not going to repeat myself. But 2026, this is your manifesto. You're going to hear a lot of noise, and these are going to be the apocalypse, the horsemen of the apocalypse that are going to come through the news for you. They're not going to drag the market down. What I'm saying is the noise is going to be there to scare you. They're the boogeymen. That's how they're going to look. I mean, they look pretty bloody scary, actually. Okay? And you got to remember, financial news is engineered for clicks. I've done a lot of Bloomberg TV to know we weren't there to give you financial investment advice. Well, I was, but we were really there to give you the news, and that meant to keep you watching. So sometimes we'd even try and be a bit, I don't know if you've seen me on BBC do the newspaper review. There have been times where I've scrunched up the paper and thrown it at the camera. Anything to keep the viewer watching, okay? And that's important. But you're not going to use that and say, oh my God, Alpesh is panicked, so we better sell. Whatever. Well, I'm not going to get panicked, but somebody else is panicked, so you should do it. These are the three things you're going to have to control in 2026, and that's your battle plan down there. This is one page which tells you 2026. I like having playbooks. I've got an A4 sheet of paper somewhere which has my various little playbooks and stuff. Just as when you watch American football and the Super Bowl is going to be on in January, they have these playbooks and they open them up. Football teams have them now, and they go, right, the other team's got a 4-4-5. Oh, God, what is it? 4-4-5. Oh, somebody who knows their football, correct me. And then the Leeds United team goes, no, we want to do 3-5-2. And we're smashing it at the moment. But anyway, 4-4-2. 4-4-2. The other side's coming in with 4-4-2. We're going to come back with this position. That's all this is. That's it. It's on screen. Okay? And that's great. What I also am going to I want to reiterate some of this stuff. The data shows we've got good, strong global economy, American economy, Chinese economy. But the news is just giving us this. War in Europe triggers something. These are your headlines. Okay? So the big thing that's going to happen is people trying to scare you compared to what's going on in the real economy. And there's a real big dichotomy at the moment between the two. Paresh, sorry, I've been yakking on a lot. Do you want to add to anything that I've said?
No, not really. I think you're doing a grand job, as you always do. It's fun to listen to you. But, one thing I would add, going back a little bit on Micron and others that have performed exceptionally well, what you're going to understand is that picture that Alpesh showed you is a picture in time. And what you won't see is that Micron did that in the last 3 months. And that's important to know. So prior to that, it was actually underwater for most of the year. So a bit like what Microsoft did in 2021 or whenever it was. So you're not gonna pick them all, but once you've got a portfolio and you understand it's a portfolio, and you'll have ones that go up and ones that go down. Your average is all you're concerned about. Your team that you are putting together for 2026. Anyway, that's me done for today. There you go.
Yeah, no, absolutely. It's a good point that when you look at 2021 is the example I give with Microsoft, it went up 50% in a year, but most of the year it caused people to panic or get bored and exit. In other words, it was either going down for most of the year or it was generating no returns. Panic means it's going down. Sideways means people get bored. Panic and boredom are the two worst emotions you're going to experience. The other thing that's going to happen in 2026, I said this in previous broadcasts, it's going to happen again. These are going to be the big underperforming fund issuers. They're going to continue to spray and pray, and there's going to be an increased death of the 60-40 portfolio split. I think retail clients are fed up with that. They want something bespoke, and they're fed up with IFAs selling them what the IFA wants to sell them, not what the client actually has asked for. And that just keeps happening time and time again. So I think what we'll see more of is the sort of death of this, and we'll see more money leaving these organizations, which for a while it's been leaving the traditional fund managers anyway, and that should continue. Our playbook, as I said, clarity, confidence. Everyone's got a plan until they get punched in the face. Don't panic. We will not be panicking. Okay, because one of these three things is going to happen. Path A, path B, path C. And this is why I keep telling people, this is your flu jab. This is your inoculation of what's going to happen and what you're going to do based on the playbook, okay, of what happens. If it's upwards, you've got nothing to do. If it's V-shaped, i.e. we get a bit of a dip, you've got a choice. Either you're going to sit through it or you're going to exit, but you might have to buy back more expensive later. Depends on your risk appetite, depends how risk averse you are. Or it's 2022, it falls. It's not even looking like it at the moment, but just in case. Okay, most of the time, it's going to be in B or C, because the market is usually in B or C, which means do nothing. Most of the time, it is do nothing. Once in 7 years, it's path A. All right? And put another way, how are we going to decide all of that? Which one of those paths it is? This, it's simple. Here's another picture, and that's it. It's simple. So I've tried to put these playbooks into sort of make it as simple that an American footballer would understand. Okay? Most of the time, it is going to be do nothing because it'll just be rising. If we get a first inclination of a mama bear, which is the monthly MACD falling, you might take some money off the table or do nothing. If you're risk averse, you'll take money off the table. If you're risk loving, you'll do nothing. And then on a daddy bear, if you're risk averse, you'll definitely get out. If you're more risk loving, you'll just sit through it all, because that's what you do. If you're risk loving, you just sit through everything. Okay. Playbook rule number 1, think portfolio, not stock, as I've already said. This is going to be critical to 2026. I feel like I'm the England football manager, or whichever team, but obviously England in my case, England football manager. And I'm speaking to the team before we go out. And it's just before the big game. And I'm saying, listen, guys, we've got this. We've got this because we've got the playbook, we've got the rule, and we know what the other side are going to come with us. They're going to have only 3 things that they can throw at us. And depending on which one of those 3 it is, that's how we're going to react. I suspect that's what they do in football matches. They say, well, we don't know what the formation is, but if it's this, we're going to do this. If it's that, Paresh, you go on the wing. Otherwise, stay in goal. Stop thinking you're a striker, etc. So think portfolio, not individual stock, and that'll help you keep calmer. Individual stocks can drop, but don't panic on that. Playbook rule number 2, only own what you'd buy more of if it drops. So value, growth, income, cash flow. So I'm going to continue, obviously, with the ones that I publicly disclosed previously that my son, wife have. Meta, Microsoft, Apple, Amazon, Alphabet, Nvidia, JP Morgan, Goldman Sachs. Then there's a whole bunch of others which I occasionally mention, but which are in one of our models. We have several models. And they're all stocks in there which have passed our value, growth, income, cash flow test, but also the type that if they drop, we'd want to earn more of them because we're picking them up at a bargain then. Okay, that's the way we're going to do it. The sensible choice for most people will be this. Unfortunately, everybody who should be sensible thinks they're a professional. Okay, they're not. Stick to the sensible choice, which for most people will be don't do anything once you've got a quality company. The emotions you're going to have to manage, don't panic. I know I keep saying it. Don't get bored. Don't get elated. I mean, we get emails from clients saying, oh, I'm up 30% this year. And that worries us because it's like, okay, you're getting overexcited. You've just got to keep calm because that's telling us that if there's a wobble, they're also going to panic. Not always the case, but there we go. Macro picture, 90% of GDP growth in the US is AI spending because the big companies spending on AI, there's a news story today about Meta going all in on AI spending. That amount of money is what normally governments spend to boost an economy. You know, in governments, you know, the opposite of austerity is spending, obviously, or expansion. And governments normally do that. But what we're seeing now is corporates do it. And those corporates, as I've said before, are doing it internationally. They are the modern East India company. They are domestic companies going abroad, sucking up all the wealth out of other countries, creating a bit, taking it abroad back to America. So, because that's the way you do it. You do it with corporations. The Brits and the Dutch did it first with the Dutch East India Company and the British East India Company. Now they're called Nvidia, Microsoft, Apple, Amazon, Alphabet. But as a friend of mine once said to me at law school, don't complain about it. Ask how you can get in on it. Well, you buy their shares. So we're in on it now. Somebody was asking me about ethics today and saying, well, are there any investments you wouldn't have just out of a reason, you know, out of ethics? I said, yeah, I wouldn't have all of them. Any of them I wouldn't have if I was being bloody ethical. What do you think these companies are doing? The enduring narrative traps, there are those, and the winning players going to be the modern day East India companies. I don't think I've heard anybody else put it that way. So there you go, an original thought. I better write it down. What people have in their pensions, that's going to continue as a problem, I'm afraid. Lack of growth is going to continue. What they have compared to what they should have, sadly, that's not going to change overnight. Part of my mission with all these webinars is to encourage more people to boost their growth in their pension. What other people want you to do is save more in your pension, which is not a bad thing. It's just that they want you to save more because it's another way of saying, give us more of your money to manage so we can charge more fees on that money, because they charge a percentage of the money you've given them. So they've got an incentive for you not to perform greatly, because if you're performing greatly, you don't need to give them lots of money because the performance is doing great. You can spend the other money which you would have otherwise given them. So anyway, this is it. This is your manifesto for the year ahead. Okay, this is your manifesto. I'm going to turn to the Q&A. I fully expect our models to be in line with this. As I've said before, these are a variety of model portfolios. Obviously, the S&P 500 is not one of ours, and neither is the FTSE All Share. They're just there as comparisons, so you can see. But I expect our models to continue in line with that. I'm going to answer the questions in a second. These problems are going to persist in 2026, I'm afraid. Each one of these problems that we're looking at, that's why we do this. They're going to persist, I'm afraid. Every single one of them that you see there is going to persist. I'm not sure I should have that picture of Bill Clinton there anymore. I'm not sure that's doing me any favors. And we're going to continue doing the same thing. We're not looking for new ideas, is my point. What we're looking for is to apply the same approach, just like Warren Buffett does that. He's had since, the last 70 years. We're looking just to apply the same approach again. Value, growth, income, cash return on capital invested, which comes from Goldman Sachs. Momentum comes from the hedge fund industry. Sortino, high average returns, low downside risk. They need to be all green as well. Okay, and then convert that into a portfolio and then look to see, this is how good they are now. How have they done since 2021, let's say, when it always must incorporate 2022 and assume that we sat through that crash. Did we still get 30% at least? Why do we want 30% or higher? Because half of 30%, if we do half as well, is 15%, and 15% means doubling your money every 5 years, which means $1 million becomes 2 million in 5 years and becomes 4 million in 10. Okay, so that's why we want at least 30 of the models as an extra sort of tick box. That'll continue in 2026, and probably the best way that helps us get that is something we've taken from Goldman Sachs Wealth Management, which is cash return capital invested. Companies in the top 25% generate 30% per annum. Okay, so we're going to continue doing that in 2026. We won't get a return as good as we got in 2023, which was 80%. Why? Well, I like saying that because I am tempting the gods to give us it. Okay, I'm going to answer Q&A now. Questions. Paresh, you talk while I'm answering and reading questions. Aegon are my workplace pension provider. Their shocking benchmark is the Bank of England base rate. I know. I do have Gate 3 access. I thought at my own investments, but they're limited to quality choices. ETFs and individual stocks are off the table unless I have an IFA tied to my account because they're too risky, but I invest in OICs and most things US. I know, Glenn, the amount of handcuffs they put. In a way, you can understand why they put the handcuffs on you, because if it wasn't you, Glenn, who's sensible, learning about investing, imagine if it was some little old lady and she decided to put it into NVIDIA. And you might think, well, that's nothing wrong with that. But NVIDIA then drops 30%, as it has been known to do. And she sells and panics. So you can see why they do it. But that's why it's good that you're well informed. Should I tell you something funny? So Aegon is a pension fund. They invested in our private equity fund because that's what pension funds like them do. That was a good decision for them, by the way. But I'm just saying, you know, I've got to declare a conflict of interest with criticizing Aegon. They were one of the corner investors of our private equity fund. It was Aegon out of Hungary, which then got nationalized. So they're no longer owners of that pension fund. And so we've got the Hungarian Sovereign Wealth Fund as a cornerstone investor of all people there. It's just by the by. Transfer period into my SIP. Oh, absolutely. A lot of people do. I'm just about to start employing my wife. And she used to work for the UK government, so she's now going to work in my company. And my accountants said, obviously, don't forget to set up the workplace pension for her, but she can opt out. And obviously, we're going to set it up for her. And then she's going to opt out straight away and put it into a SIP, and where we're going to make the employee contributions, etc. Because I would not want it in those standard, the standard ones, which are what's people's pension, Nest, is Nest one of them, and so on. Given Mark Carney's Canada's strategic capital divestment out of the US, can you see this as a problem for the US market? No, the US market is so much bigger than those little things happening. So what often happens is we see these small stories, relatively small stories in size and number and volume, and people have a tendency to overreact to them. I could be wrong, got to always allow for that, but people tend to overreact to them. And, people would say, well, wait a minute, what about all these H-1B visas and these Indians not coming over and providing, jobs in Apple and so on? It's not going to have a near-term impact. And I only need to worry about, do I hold my positions today? And then tomorrow I can have another think. And I'll think, I don't need to worry. In 5 years, is it going to be a problem? So let me react today. Okay? And that's the way to look at it instead. That's the way to look at it. Okay, are there any questions I've missed?
No.
MU did not meet GIP requirements for Croquis.
Hedge was asking about Micron.
No, but it's in one of the model portfolios. It might not have met it this month, but when we created the model, it's in the model. So it got in through the model portfolio, not through the Croquis route. Okay, any other questions in there? Thanks for the offer, but I'm good. Let me correct it up to the point of my employer matching. Employer matching is very important. The SIP that I take a little more seriously. Absolutely. What you might be able to do is ask them, what's the most adventurous, I think they call it, fund you can put in within Aegon. You can always ask them, look, I know your guys are limiting me. Okay, what's the most adventurous thing I can do? Because it sounds like you want more growth than they're willing to give you. That's it. We have crossed over by 8 minutes. I try not to do that with these things, but we have crossed over by 8 odd minutes. So that's the last one of the year. Happy New Year, everybody, and we will see you. We'll continue producing the content. If you haven't already looked at, actually, no, you better look at this. Actually, I've got a New Year's gift for you all. We have got, if you've not seen it, we have got a bunch of free pension calculators at campaignforamillion.com. In case anybody hasn't seen these, and these are phenomenal. Okay, you can even rate your pension. You might be able to do this with Aegon, and you can show them the numbers, and you can put in, like here, you can put in Aegon. Whoops. And you can put in the approximate. You don't have to. We don't get this data, by the way. It's kept within the machine, so it's not like we wouldn't even know who you are when filling it in, because we don't ask for your name or email or any identifier on there. And let's say you've got 100,000 in there, and you've had it in for 5 years, and your average return has been probably 5% if you're lucky. And then you rate it, and you got a D rating, because we'll show you what that means. I mean, obviously there you told us what your return is, but we'll also work it out if you don't tell us. And it'll tell you what would have happened if you'd had one of our models. It also will tell you your Sharpe ratio, how rubbish it is. You want that to be above 1 if you're any good. So a benchmark like 1.89 is very good. So you can do all of that. And then you've got my videos on there as well, the latest on TikTok. 1.8 million likes on TikTok, 450,000 followers. We're going to try and take that in 2026 to 1 million followers, I hope, as well. So that's some of the calculators. There's another good calculator here for safe withdrawal rate for those who are closer to withdrawing. If you're at the younger end, you'll like this FIRE tool, which is financial independence, retire early, depending on your age, goal, rate of growth you're getting, how close are you to getting what you need. So that's a really good. They're all free. Lifestyle calculator, portfolio stress test is really good because it reduces your reduces your stress, hopefully. The stress test portfolio, expected annual return volatility, and then you can run the stress test and work out what the worst and best cases are, the median scenario, lucky versus unlucky. Would you survive if you got an unlucky sequence of returns, unlucky being within the same volatility that you've had, but what would happen? And it also goes and gives you explanations on decoding the results and so on. All of this without picking up the phone to a financial advisor, because then you can be better informed. You can sort of understand what is this stuff that they're talking about. And I just think people tend to find that a lot better if they can play around with numbers themselves. Without, I don't know about you guys, but I like to sort of done my own research first before I just pick up the phone and even tell you what your success probabilities would be there, 37.4%. If these were, and you might say, well, actually, I better withdraw less then. And if you do, you've increased your success rate. Or you might say, I better boost that return. Okay, and try and get closer to what the Americans achieved. Great, you got 94.2% success rate there by playing around with some of that. Okay, so you can do all of that. And I think the advantage of that is when you're speaking to an IFA, you can't keep going back and forth and saying, oh, can you play around with this? And what if I do this? And what then? And plus, they give you the information in a way where you think, what the hell are they talking about? Whereas what we've done is we've put little simple explanations there, made it absolutely easy. And as I said, you don't even have to put your email address in or any detail. There's no details you have to put in. They're just completely open access, as it were. So do have a look at those, because that's one of the great things we did in 2025 in creating those. Really happy with those apps. And Paresh will tell you, I think one day I said to him, it was 4 a.m. I said I went to bed the night before, and I woke up in the morning and spoke to him, and I said, I'm really excited, Paresh. I said, we've got all these apps that we've put together.
Yeah, the rest of us sleep at night.
Whereas other people, normal people sleep. But 280,000 subscribers on YouTube as well. So that's the highest we've ever had as well. And 450,000 on TikTok. So hope you will all continue following us in 2026, I guess, is what I would say to everybody. So thank you all very much. Thank you. Yeah, and Paresh has said if anybody wants to book a call with him to get a free pension education review, do feel free to do that. Yeah. As well. Oh, we've got some more messages. In the UK, investing in the S&P 500 in sterling terms are affected by exchange rates. Can I invest in USD? You can invest in US dollars, of course. You just have an unhedged. My S&P ETF is in US dollars. If you look at, say, somewhere like Wisdom Tree or your broker, they should have, when you put in S&P 500, they should have a range of offerings, and it should tell you which are USD and which aren't. Can we have a chat tomorrow? Yeah, Paresh, Mick.
Yeah.
Stuart, my ISAs are maxed out, so my wife's I only work part-time. I did a lump sum investment into my ISA max in certain stocks. Have I made a mistake? Because my income was too low to add more money. We dropped out hours to semi-retired. We're living off cash piles. Any help, guys? Will you email me? Me and Paresh, so I can have a proper analysis of what you're saying, and I can give you a proper email back. People find that surprising. Sometimes people say to me, can we have a quick chat? And I say, well, actually, can you email me? Because a lot of these things I want to think about and get it right, rather than just give a top of the head answer and give a more detailed answer. So, and also the other reason is, if it's something affecting you, it's probably affecting other people, and I might even write a more detailed piece about it. Speaking of which, I've had a lot of people saying, well, where can I get more income? So the thing here is, I've done a whole load of blogs recently on bond funds and fixed deposits, okay, or low risk fixed income options for UK investors, and they're really detailed. This is what I mean, Stuart. If you email us, then it might be something as detailed as this I put together, not just for you, but for other people in a similar situation. Without, obviously, we won't disclose anything confidential that you give us. But the point is, this is what I mean about giving a proper answer. I'd rather give you a proper, detailed answer than something off the top of my head. Okay, so yeah, I mean, if it was a TV show and it was a call-in, then yeah, bang. I'd just say to you, I don't think you've done anything bad by maxing out your ISA allowance. It's usually a very good thing to do. So I don't think so at all. But yeah, we've done all, I mean, that's a lot of research that goes into this. I have people to help me, obviously, to do all this. But it just answers that question, because I think a lot of people, they say, but surely I can invest in government bonds or something to get higher rates of interest. So we compared it all. We even, there's all the sources that we took for it. So that took a while, actually, to get done. But it's December 2025 updated. Okay, so that's there as well. I'll come to the books in just a second. Bum. 3 good books. 1,000 Baggers, Die with Zero, Warren Buffett and the Snowball. Read them, guys. Yeah, Stuart, no. 100 Baggers, I don't know. But I've just going to do a blog on, I think I did do the top books. I might not have done. I thought I did the top investment books. But anyway, they'll be on the blog if I've done it. The top investment books. I thought I had. Clearly, I haven't. Okay, that doesn't matter.
You did. You had 10 top books.
Yeah, I thought so, and I thought it would be here, but I can't seem to find it because there's so much stuff. As an author, you can imagine I like writing, so that's why there's a lot of stuff here. Anyway, thanks, Glenn. Thank you both. Happy New Year. Live long and prosper indeed.
Right. Gotta go.
As would say. Right, I better go now. Any other questions, just email us, guys.
All right. See you later.
Thank you all. Wishing you a happy, peaceful, prosperous 2026. Okay.
See you soon.
Thanks, everyone. Thanks, Paresh. I'll speak to you tomorrow, Paresh.